Hi, I'm Michael Perry from Sims Investment Management, and for today's Teaching Tuesday topic, we are going to talk about capital gains. And more specifically, we're going to talk about the difference between short-term capital gains and long-term capital gains. So first off, what is a capital gain? Well, imagine that you buy a stock and then you sell that stock for more than you purchased it for. Well, depending on the time frame and how quickly you've sold that stock, that's going to really determine if it's a short-term capital gain or a long-term capital gain. And there's some key differences between those two things. A short-term capital gain is for any stocks or assets that you've sold with a time frame of less than 1 year. And short-term capital gains are taxed at a higher rate than long-term capital gains. That's one of the important distinctions between the two of them. So short-term capital gains are taxed at your ordinary income tax rate. So there's a range, from 10% all the way up to 37%. And whatever your ordinary tax income rate is the amount that you would pay on the gains from that sale. Long-term capital gains are a little bit different. They are taxed at either 0%, 15%, or 20%. And for the majority of people, long-term capital gains are taxed at 15%. And that's for any assets that you've sold with a holding period of longer than 1 year. So just to set up a scenario for you, I'm going to choose Apple just as an example. Say that today you went out and you purchased 100 shares of Apple. Apple's trading for about $200 a share right now. So that would put your all-in investment to about $20,000 or so. And that's your cost basis is $20,000. Now let's imagine 11 months from now, 9 months from now, any time frame that's under a year, you decide, hey, I want to sell these shares of Apple. And let's say at that time, those shares are now worth $25,000. So you have your cost basis of $20,000. Then you have the shares valued at $25,000 right now, and that capital gain amount is going to be $5,000. Now, if you decide to sell those shares, you have a capital gain of $5,000, and if you sell them after holding them for less than 1 year, you're going to be taxed at short-term's capital gain rate, which again is your ordinary income tax rate. So let's say that number is 30% for you. That's your ordinary tax rate, ordinary income tax rate. So on that $5,000 of gain, you're going to owe $1,500 in short-term capital gains tax. Now let's say, hey, you decide you wanted to wait a little bit longer to get the benefit of long-term capital gains. So you wait, instead of 11 months, you wait for 1 year and 1 day or any holding period longer than 1 year and 1 day. Well, now you're going to be taxed at long-term capital gains rates, which for the majority of people is 15%. So instead of paying $1,500 in short-term capital gains rate, since you decided to hold that asset for a little bit longer, you're only going to pay $750 in gains on that $5,000 worth of profit. And that's really important when you're looking at tax planning and deciding when to sell assets, how long to hold on to assets, and in an area that a financial advisor can be really helpful to you in is to help you strategize and decide which assets make the most sense to sell and at which times, and to do some of that strategic tax planning with you. So I hope that you found today's Teaching Tuesday video helpful, and I look forward to seeing you again next week. Take care.